All right, so now we're going to carry on with section one, which is the time value of money. We have actually an interesting derivation to go through, and then we're going to move on to chapter or section two, I should say, where we're going to be looking at the measurement of interest rate risk. Okay, so right here at the end of section one, we do have well, actually, first, before what we had just done last time was we introduced the two formulas for the future value of an annuity and the present value of an annuity. And I did mention that proving them is not too difficult, so we're going to give it a shot. So here's the future value of an annuity. And of course, the beauty of this formula is that you can calculate the future value of any number of cash flows as long as they're equally spaced and they're all equal to each other. Normally, an annuity takes place on a yearly basis, but sometimes you can see it also can happen over a monthly basis. For example, when you take out a car loan, you probably notice that the amount that you pay every month is exactly the same. So, same thing with a mortgage. So you could think of those as a special type of annuity where the cash flows occur every month instead of every year. And these formulas can be used for that purpose too. In fact, if you jump ahead a little bit, you can see that if you do have monthly payments, then that M in that formula just becomes 12, and that changes it from, of course, annual payments to monthly payments, and then you're all set. So it's a very powerful formula. But where did it come from? Okay, so we're going to end up needing to rely on infinite series to get to this result. So let's take a look at how this works. Okay, here we go. All right. So the present value of an annuity. Now, okay, we're starting present value. Hold on one second. All right. So again, we want to derive these just to see where they come from. So let's start with the present value of an annuity. So now, of course, the annuity has a finite number of payments. We'll call that N. Okay, and now C is a constant. It's the annual cash flow or the repeated cash flow. If it's monthly, like for mortgage, then C would be the monthly mortgage payment. R is the rate of interest. Now, the rate of interest is going to be consistent with the time frame. So if these are annual cash flows, R will be an annual rate of interest. If these are monthly payments, then R would be a monthly rate of interest. So we can see that there can be any number of periods, although it is finite. And what we can do is define X to be 1 over 1 plus R. One over 1 plus R. So if that's the case, then what we end up with here is PVA now suddenly equals XC plus X squared C plus dot 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 X to the N C. All right, well, there's nothing mysterious about that, but here's the interesting part. Oh, I see. I wrote them with the C first. It doesn't really matter, obviously. I'll tell you what, let's just change it to be consistent with the slides. Now, if we multiply PVA by X, we'll get CX squared plus CX cubed plus CX to the fourth plus. So now we're going to subtract one from the other. And if you look at it carefully, you'll see that all the terms will drop out except the first and the last. So there's these drop out, all the way out. So you end up with CX minus CX to the N plus 1. And then we can do some factoring. Actually, this is CX. Okay, so now we can divide both sides by 1 minus x. All right, so what does that get us? Well, now we're going to make some more substitutions. And so this is where we are right now. But so what we're going to do is make some substitutions. In other words, we're going to bring back the definition of x into our equation here. And we're going to see what happens. So remember, we define x to be 1 over 1 plus r. So that means what we actually have here is this. So all the x's will be replaced with 1 over 1 plus r. Okay, so now what happens? Well, now we got to obviously simplify it. And so one thing we can do is multiply it across in the top term, top two terms. Oops. And let's see, where does that get us? All right, so now we have okay. Let me just neaten this up a little bit. All right, so you can see we're going to end up with a common factor here. Actually, I probably shouldn't have consolidated these two because let's do this. Now we can cancel some stuff out. We're going to have C. Okay, and that should take care of it. So let's go back and get the formula that we start out with. And you can see that except for writing this as 1 plus r to the minus n instead of 1 over to the positive n, it's the same formula. Okay, so in other words, that's it right there. That was our proof or derivation, I guess we should say, that this is in fact the correct value of the present value of an annuity. So that's why this formula looks like this. By the way, I do want to mention here at this point that there does exist in the financial markets an annuity with an infinite number of cash flows, can be priced as wow, that's interesting. So this type of annuity is referred to as a perpetuity because you can see the word perpetual hiding there. And the reason for that is because what we're actually doing here is taking the limit of this case when n goes to infinity. This goes to zero, and we're left with C over R. Interesting. Now, you might not think this would be terribly useful because, of course, in the real world, when do you ever see a perpetuity? Well, you'd be surprised. There have actually been cases where bonds were issued in the form of a perpetuity. In other words, a bond, and we, by the way, we haven't started talking about bonds yet, so this might be a little premature, but a bond that provides interest payments forever, but no repayment of the borrowed principal is a type of perpetuity known as a consul. Now, again, you might say, well, there's no way anyone has ever actually done this. Well, the British government, whoops, consul with an L. Believe it or not, the British government issued consuls to finance the wars with Napoleon Bonaparte. I guess they're afraid that they might not be able to repay the principal before it became due. So they figured, well, it'll be safer this way. If we win, we'll just make the payments forever. If we don't win, well, what's the big deal? We won't have to pay them off anyway. So they were issued during that period, and there's been other periods in history where consuls have been issued. Now, eventually, the British government went out and found the owners of these consuls, and they bought them all back. So they're not still out there paying interest, but they would have if they'd never been repurchased by the British government. So they have been issued occasionally throughout history, very, very occasionally. Once in a while, you see something that comes close, though. In the early 90s, Disney issued 100-year bonds known as Cinderella bonds. But that's an informal name in the market. No, Disney didn't call it that. I guess they figured somebody would buy them. So that's awfully close. That's as close as you're going to get to a console without it actually being a console. Now, another area where this will show up later on is that a preferred share of stock has features similar to a console or a perpetuity. Because what happens with a preferred share of stock is that you're basically getting more or less a predictable stream of dividend payments, but you're not getting a whole lot of opportunity for capital gains. Okay, so a preferred share of stock provides a steady stream of income with very little growth potential. With common stocks, the ones that you normally think of as stocks, it's the other way around. You're not getting a whole lot from the dividends, but you are getting a lot of growth potential. So these are set up for investors who just need income. Okay, so a steady stream of income with very little growth potential. Another thing to keep in mind is that a share of stock has no finite lifetime. In other words, it doesn't have a specific maturity date. So it's called a maturity date. So a company like Coca-Cola, which has been around more than 125 years, those cash flows will continue to go on forever. If you bought a share of stock when Coke first came around in the 1890s, it's still a valid share of Coca-Cola stock. So any dividends that were paid out over that period would have a lot of the same properties as a perpetuity, because no, it's not an infinite stream of dividends, but it's compared to our lifetimes, it certainly is. So, this idea of a perpetuity is not all that far-fetched in the real world. So, but think of it as the limiting case of an annuity. An annuity with an infinite number of periods becomes a perpetuity, and its pricing model is very simple. Um, so it ends up being C over R. Now we're going to do the same thing with FVA, future value of an annuity. We have a simple derivation here to show us why this is the case. Right, and so let's see, where does that come from? Now here, what we're going to do is rewrite it in a kind of an interesting way. So keep in mind, with the future value of an annuity, remember each cash flow is being invested uh, every year until year end comes along. So that's what we're assuming, by the way. With an annuity, there's an implicit assumption that all the cash flows are being reinvested in something else that's giving us the same rate of return. So um, here, we're rearranging it in terms of how many years the cash flows will be invested. So in other words, the cash flow received in year N is invested for 0 periods. So its future value is not just C, that map that you actually receive. This one, um, this is received in year N minus 1. Which means it'll be invested for 1 year. And that's why this has an exponent of 1. Also remember, by the way, I want to remind you that these two formulas we are working with now are ordinary annuities, which means that the payments start 1 period in the future, not right away. So that means this is the cash flow received in year 1. Now, year 0 is today. So this is received 1 year in the future. Therefore, it is invested for N minus 1 years. Okay, so that's the logic behind this equation. How many years is this cash flow being invested for, given that this is an N year annuity? So remember, the first cash flow starts in 1 year. So therefore, it is being invested for N minus 1 years. The last one is invested in year N. So it is invested for no years. So now we're going to make some substitutions, just like before. And so X will be this time just 1 plus R. Okay. And then, I see what's happened here. It's been rearranged. Okay, that's fine. And this one is just C, of course. So then it ends up with CX to the N minus 1 at the end. And then once again, let's try the same trick we had before. Subtract. And again, all the terms will drop out except the first and the last. So that equals that minus cx to the n. So we can do some factoring. Let's do that right now. Okay, and then we can factor out the c. And now we can replace everything with 1 plus r. All the x's become 1 plus r. Okay, so we have and that reduces to. And if you look carefully at that formula, let's see. Oh, you know what? I just realized something wrong. This is negative. 1 minus 1 minus r. Yeah. So that means we actually have. Now we're good. Okay, we're all set. Okay, I missed that negative. Okay. And that's how we derive the two formulas. Now, of course, in a case like this, if you were looking at trying to figure out the future value of a perpetuity, it would just be infinity. So there's no mystery about that one. All right. Now, bond pricing formulas. Now, I did mention before, we haven't really talked about bonds yet. So I just want to remind everyone, or at least introduce you to this concept of bonds. A bond is, as it says here, a debt security or debt instrument. And what happens with a bond, where the investor pays, well, let's just say the investor, um, the bond, let's think about this in English. Bond is a debt instrument that is issued with a price known as the face value. Okay, this is good. Or sometimes it's called the par value, which is usually, but not always, $1,000, at least in the United States. Every country's bond markets are a little bit different. So usually $1,000. The bond has a fixed maturity. And so during the lifetime of the bond, the issuer will make interest payments known as coupons for historical reasons to the investor every year until the maturity date. at which time the face value is repaid to the investor. Okay, so in other words, let's just make a very quick, simple example. Um, Suppose that a bond is issued with a 5-year maturity, $1,000 face value, and what's called a coupon rate of 6%. The investor's cash flows will be okay. So in the initial today, year zero, we pay $1,000, and then next year we get $60. Why 60? Because that's 6% of 1,000. But in the last year, we get not only our $60 coupon, but we also get our face value back. So those are the cash flows that would be paid and received by the investor in this bond. Okay. And so this, and by the way, bonds, if you see how well organized these cash flows are, they're very predictable. There's a very strict structure to this. Bonds are an example of what are called fixed income securities because the amount of interest that you earn every year is fixed. It's decided in advance. It doesn't change. Okay, since the cash flows are fixed in advance. Now, just as a quick aside, bonds are issued by governments to cover their deficits, by corporations to invest, typically to pay for expenses, and also to reinvest in the corporation. So let's say Apple sits down and says it's time to design the next iPhone. We need $100 million in a hurry, or whatever it is. It's probably in the billions. Where do we get it from? Well, we don't have it laying around in the corporate vaults. So instead, we issue bonds to the investors. And so they give us money up front. We pay it back in stages. In other words, we give them interest every year until the final year, at which time we repay the money. And what we're hoping is that, let's say, the bonds cost us a 6% coupon payment every year, but the rate of return from building the new iPhone is 10% or something like that. Then, as far as we're concerned, it's a good deal because we're getting more back from our investment than it cost us to borrow in the first place. And also, bonds can be issued by domestic and foreign bond corporations and governments in the United States. It is possible to buy foreign bonds in the US, but they're all structured in a very similar way. So it turns out then that we can use the present values formulas we were just looking at to calculate the market price of a bond. Now, the market price of a bond can be very different from the face value of the bond. The market price is nothing but the present value of the bond's future cash flows. Which means that we can calculate it very easily as the present value of an annuity, the coupon payments, and the present value of a sum, the face value. We can calculate both present values, add them up, and we've got our results. So the interest rate that is used to compute these present values is known as the bonds yield to maturity. Often it's simply called the yield. The yield reflects several factors, including the maturity of the bond and the credit rating of the issuer, as well as the overall level of interest rates in the economy. So in other words, if you look in the Wall Street Journal, you see that Apple yield on an Apple bond is 6%. There's several reasons for that. Apple bonds are very safe. They have a very high credit rating. Um, we don't know what the bond's maturity is until we look at the specific details. And right now, interest rates in the U.S. economy are relatively low levels, um, by historical standards at least. And so yield is a reflection of the return that investors expect to get when they own one of these bonds. Okay, so now a couple of details here I just want to mention. In the US at least, it is normal for interest payments to be paid on a semi-annual basis. So in the last example, investors would receive not $60 a year, a $30 twice every year. And that's where the name semi-annual comes from. That's just a convention. I don't know how that got started. The other thing that's of interest is the word coupon. Um, the word coupon, normally when you see the word coupon, you go to the supermarket and you buy groceries and they print out your receipt plus these little strips of paper that might say this entitles the owner to $1 off in their next purchase of paper towels or something like that. So, or in the past, you would have in the newspapers, you would have these coupons in these ads for supermarkets, and you'd have to take a pair of scissors and cut them out and bring them to the store to cash them in. So, how did this happen to be the name of the coupons, the cash flows in a bond? Well, until recently, ownership of a bond was demonstrated through the holding of bond certificates. Just like stocks, there were certificates, and if you bought a bond, let's say from AT&T, you would get this little certificate. Not little, it would probably be the size of a college diploma, and it would have all the details of the bond on it. And here's the part that is the most interesting. You may have seen, by the way, pictures of historical stock certificates. They're very nice. They're really works of art. They're intended to impress people with a corporation, and so that's why they look so amazing. But with the bonds, now keep in mind the period I'm referring to now is pre-computers. So I'm gonna see if I can find one that works for us. This I find from experience, this is very difficult. Oh, stock certificates are easy to find. There's so many of them because people care. There's something about bonds that makes people tend to think of them as kind of boring, not that exciting. Oh, okay, now we're getting a little away from where. Um, let's be more specific here. Okay, I think we got a winner right here. Well, assumed internet, but whatever company this was, you can just barely make it out. I can see that in January of 1935, this little strip of paper on the top here is a coupon. And what would happen is somewhere on here it mentions a dollar amount, and you could take a pair of scissors and cut this off and bring it to the bank or mail it into the company, and they would send you a check for the size of your coupon. So if it says $10 on here, you would get a $10 check, and that would be your coupon payment because you're redeeming these cash flows literally with coupons on the bond certificate. That's part of the reason why it's so hard to find bond certificates with these coupons, because that means somebody never cashed in all the money they were entitled to. That's why they're called coupons. And they kept, even until way into the 70s, I'm going to say 80s even, you could still get bond certificates with the coupons on them. Eventually, computers made all that unnecessary, but that's where the word comes from. Anyway, so what's important here is this. On the day that a bond is issued, its market price equals its face value. On the day that a bond matures, the market price equals the face value. At any time between, as interest rates fluctuate, which they do, market price of the bond can rise or fall and will not necessarily the face value. Specifically, when interest rates go up, bond prices fall and vice versa. So there's always an inverse relationship between the level of interest rates in the economy and the prices of bonds. When rates go up, the present values of your cash flows go down, and so therefore so does the price of the bond. When rates go down, it's the other way around. Okay. So what we're going to see here in the slides is, oops, I know that's coming later. How do you actually price a bond? Oh, by the way, just as an aside, there's another type of bond out there. These bonds are known as coupon bearing for obvious reasons. There are also bonds in the market that do not pay any coupons. They're known as you can imagine, zero coupon bonds. So why in the world would you buy them? Because they are sold initially at a discount from the face value and then redeemed at maturity at the full face value. For example, a 1-year zero coupon bond with a face value of 1,000 might sell for, let's say, 925 when first issued. The investor pays 925 and then receives 1,000 at maturity. Instead of earning a coupon payment, investor has just earned a capital gain of $75. But most bonds in the economy do actually provide coupon payments. Usually it's only the bonds with extremely short maturities that are sold this way. Okay, that's just the market convention. So that means that if you can see here, the price of a coupon bearing bond looks like this. So you can see that every year we get a coupon, except in the last year end, we get both a coupon and the face value. Now, this looks like a lot of work, but if you think of the coupons as an annuity, then what you can actually do is calculate the price of the bond can be determined by applying the present value of an annuity formula to the coupons, and then using the present value of the sum or applying the present value of the sum um, formula to the face value. So you only need to do two calculations, and that will give you the market price of your bond. And the R in this case is what we meant earlier by the yield to maturity. And that's the part that can change every single day. All right, the C and the F are fixed in place. Now, by the way, when you do buy a bond, the investor in a bond is actually entering into a contract with the issuer. This contract is known as an indenture. So the indenture contains all the details, such as the coupon rate, maturity, its value, and any special features the bond may contain. And there's quite a few that are fairly common features. It's all specified in the contract. Now, if the issuer fails to make any of the payments in a timely manner, then the corporation can be sued for bankruptcy. And that happens once in a while. It's not a common thing, but this is why it's important to know how creditworthy an issuer is. So in order for investors to know, to understand how much credit risk each bond has, there are ratings agencies, as they're called, such as Standard & Poor's, Moody's, you may have heard of these companies, Fitch, etc., that provide ratings for every bond in the economy. So you can consult those ratings to see how much risk is involved. Bonds with the weakest ratings must offer the highest coupons payments to entice investors to buy them. Okay, so that's how that works. In other words, if you, let's say, for example, by the way, I just want to mention quickly how these ratings work. Standard & Poor's ratings look like this. You've got, you're at the very top of the pyramid here, you've got AAA, AA plus, then AA minus, plus, A minus. Then it goes down to the B's, triple B plus, triple B minus. Now, this collection of ratings, these are all referred to collectively as investor or investment grade bonds. Then you have the so-called junk bonds, and they would have ratings like triple B minus. I'm sorry, I missed. There it is. That's why it's down there. Double B plus is the beginning of the junk bonds. B plus, B, oops, B minus, and then it goes down to triple C, and then we're getting to some really scary territory down here. Bonds in this neighborhood are right on the brink of bankruptcy, basically. And it goes down, I think it may go all the way down to D. Those are the really dreadful bonds. So anyway, the reason why I show this to you is because I want you to see that if, for example, um, suppose that a AAA corporation issues bonds with a 4% coupon rate, let's say double B plus corporation might have to offer investors, let's say a 9% coupon rate in order to entice them to buy the bond. Otherwise, nobody will touch it with a 10-foot pole. I mean, you know, there has to be a higher rate offered in order to compensate you for the risk of default, as it's called. When the issuer fails to make the payments on time, it's known as default. Default is bad news. When there's a default and there's a bankruptcy, the assets of the corporation are liquidated and sold and distributed to the bondholders. But you might find yourself getting back half the money you invested in a bond when this happens. It's not a good situation. So anyway, going back to the formulas, this is the simpler version. Well, in a way it is, but we just consolidated all the terms on the left into this one. But you can see more clearly maybe that what you have here is the present value of an annuity. And the present value of the sum. And so you really realistically only need the two terms to come up with the price of a bond. All right, so here's a treasury bond. Now, this bond is issued by the U.S. Treasury Department. Now, the U.S. Treasury is responsible for raising funds for the U.S. government. And because they always have a deficit, always it's a huge deficit, the Treasury issues bonds to the public. To raise funds to cover the government's deficits, which is, every year. Now, these are collectively known as Treasury securities. Now, they're actually, in fact, let's take a look. There's a website we can look up the yields that are being offered to these treasuries. I don't think this, oh, this is the main page. Data. This is where we should go. And so what's going to happen here? Let me save this link. And so you're going to see across the top here, these are the maturities. And down here, you can see the dates on which these applied. And then you've got the actual yields. So this goes all the way back to the start of the year. So um, that hasn't changed much this year. This set of numbers is often referred to as the term structure. It's referred to as the term structure of interest rates. And a graph shows this relationship is known as the yield curve. So what you're seeing up here is that the Treasury offers maturities ranging everywhere from 1 month to 30 years. That's unusual. Corporations typically only offer very long-term maturity bonds, like 10, 20, 30 years. The Treasury Department has everything. So everything under the sun from 1 month to 30 years. So there's actually separate names for these different securities. Um, so in the Treasury market, bonds with maturities from 1 month to 1 year are known as treasury bills. So even though they're technically bonds, they're very short-term bonds. Bonds with maturities from 2 years to 10 years are known as treasury notes, and the bonds with maturities from 20 to 30 years are known as treasury bonds, actually. They're actually called treasury bonds. So we've got treasury bills, treasury notes, and treasury bonds. Although technically they're all bonds, this is the market convention. Now, what's interesting here is that treasury bills are sold as zero coupon bonds, meaning they're sold at a discount from the face value. The rest are sold as coupon bearing bonds. Okay, and there's other differences too, but those are the important ones. And by the way, yield, I'm going to see a lot of this as we go along. Yields on treasury securities are considered to be the risk-free rate of interest for a given maturity. And that simply means risk-free, in this case, means free of default risk. Okay, now why is that? Well, the government's in a unique position. A corporation can run out of money, end of story. They can go out of business. The government can't go out of business. If they run out of money, they have other options. They can raise taxes, for example, they can sell off assets that they own. They have other ways of raising money. So they're not going to allow themselves to not pay these treasury notes, treasury bills rather, and treasury notes and treasury securities, because that would ruin their credit rating and would cause the cost of borrowing to go up a lot. So they'll do whatever it takes to make sure you get your money. So this is the one type of security where we don't have to worry about default risk. For the rest of them, there's always a chance something could go wrong. And that's why those ratings exist, so we can tell them apart. But yes, as we go further into the course, we'll see, especially when we're looking at derivative securities, that risk-free rate of interest will be a hugely important concept. All right, now, I think what's coming up next is an example. Oh yeah, here it is. So we have the face value of 1,000, the annual coupon, just to keep it simple, we're going to use an annual coupon of 70. The 4-year rate of interest, which is the yield to maturity, by the way, is 5%. So this is what the market price looks like. So 4 years. Now, by the way, this, even though this is a 4-year bond, that doesn't mean necessarily that it was issued right now with 4 years to go to maturity. It could have been issued, let's say, it could have been a 30-year bond issued 26 years ago. It could have been a 20-year bond issued 16 years ago. Right now, at this point, all we know is that there's only 4 years left. So you notice how this coupons are $70. The yield is 5%. So when you actually calculate those numbers, those present values, they add up to $1,070.92. That is the market price of this bond. And you can see it's higher than the face value. Now, here's another interesting twist. When bonds are first issued, their coupon rates are chosen to match current yield to maturity of a bond. So, in other words, for example, if a corporation issues a 30-year bond and the corporation, the credit rating of the corporation is such that its bonds have a yield to maturity of 7%, the corporation will choose a coupon rate of 7%. Okay. So in other words, this is the convention. Your yield will determine your coupon rate when it's first issued. The coupon rate never changes, but the yield to maturity does. This is why the market price of a bond fluctuates over time. All right. So, and of course, we could just go ahead and use our wonderful annuity formulas, and you'll get the same thing. Now, this is where it gets interesting. By the way, if you were to take, we didn't get to this point yet, but suppose you took a bond and recalculated its price with different yields to maturity. Let me see. I don't think I have an example of this right now, but if you were to take this bond and you wanted to know, well, what would be the price if the yield was 6 or 8% or 3% or whatever, and you did it many, many times and you plotted the relationship between the two, you'd end up with this special graph, which is known as the price yield curve. Now, what's interesting about this is that clearly the relationship is inverse or negative, which means the slope of this curve has to be negative, but it's not a straight line. It looks something like this. Oh, now that is interesting. So clearly the first derivative of this function is negative. So if you can think of the price of the bond as P of R, then the first derivative is clearly negative. You have all these slopes of the tangent lines along this curve are negative. But if you notice, as you go to the right, as x increases, the slopes are becoming less negative. So that means that the second derivative is positive. And that means that the curve is not only not linear, it's said to be convex to the origin. Convex. Okay. Now we'll see when we start looking at the risk measures how important this proves to be. Now you might think, well, oh, what's the big deal? This is actually very helpful to the bond investor. All right, here's why. Because let's just imagine that you have a bond and let's just say that at the moment, the yield is 7% and the price is 1,000. If the yield goes up to 8%, say the price drops to 920. But if the yield drops to 6%, the price goes up to 1092. Now, of course, I just made up these numbers, but I mean, the principle is the same. So what this is showing us is that there's an asymmetry between the gains and the losses to the investor as the yield to maturity changes. So if the yield rises by 1% from 7% to 8%, the price drops by $80. But if the yield falls by 1% from 7 to 6, the price rises by $92. So in other words, you see how that's helping us. We gain more on the upside and we lose less on the downside. If we had a straight line, it would be the same on both sides. So the convexity is actually helpful to the investor. Okay, and we'll revisit this discussion when we get to section 2, I should say. So this is our price yield curve. Also, I want to point out that some bonds have more convexity than others, and we'll discuss that as well in the next section. Some of them are very highly convex, and some are not very convex at all, but this relationship is very close to being linear. All right. So that price yield curve is going to prove to be a huge deal in this area. Now, one thing I do want to point out here, which is kind of interesting. Based on the way it's drawn, the price yield curve, we'll call it P of R, the price yield relationship is monotonically decreasing. Ooh, all right. Remember what that means. It means that when R is rising, P is always falling with no exceptions and vice versa. This guarantees the existence of an inverse of P of R. So as a result, we can do one of two things here. Find the price of a bond from its yield, or we can also find the yield of a bond from its price. Oh, no apostrophe. And so we're going to do exactly that. There's just one problem, though. We don't have a lot of information about every bond. In other words, you don't have an infinite amount of information about each bond. They're all somewhat unique. And so what that means is that it's not realistically possible to actually estimate a functional form for P of R. It has to be sort of estimated from sporadic, let's say, market data. So we can't take the inverse of P of R to solve for yields. Instead, we must estimate it. We must estimate yields using numerical methods, specifically root finding techniques. Oh my God. So it sounds like we're getting into some extremely deep water here. And the ones that we're going to consider are the method of bisection, Newton-Raphson, and the secant method. So you may have heard of these before. This is getting into a more specialized area of math called numerical methods. You find this either in a computer science department or a math department, or possibly both. And so these techniques are reserved for cases where we don't have necessarily the ability to estimate a function properly. Instead, we have to estimate it. Like you might remember from calculus, the trapezoidal method that's used to calculate the area under a curve. And then you take the limit and that gives you the integral that you need. So, but even then, we're assuming that we know the function itself. Here, we don't have that luxury. So we're going to try these, or at least understand how these techniques work to see how they look for a solution. Of course, they all have their own advantages. They all have their own disadvantages, but for example, the method of bisection takes the longest, but it's guaranteed to converge to the correct solution, whereas the other two, they can get stuck, so to speak. So anyway, I think we may as well save this for the next discussion because it is fairly involved. And but I think you'll find it very interesting. And when this is done, we're going to move on to our discussion about risk, interest rate risk. We're going to define a new measure which helps us directly compare the interest rate risk of different bonds to each other on a side-by-side basis so we can make decisions about which ones to buy and which ones to avoid. Okay, so in other words, if you're a bondholder, aside from credit risk, the biggest fear that you have is that interest rates will fluctuate and that will reduce the value of your bond. So we have to consider not just credit risk, but also what's called interest rate risk. All right, anyway, I guess we can stop here and it's kind of like a cliffhanger. You want to know what's coming next, but don't you worry. It'll be very soon before we're ready for another session. So I'll see you then.